coming down, maybe like a 50%. Okay, now let's talk about this trading behavioral economics. So this is one of the example, okay? You can probably answer in the chat if you want. One is the game one, okay? Coin toss game, only once we can do, and then heads is how much? I don't know. Like I will tell you here. Then tails lose. If you get the tails, then you lose 1,000. If you see the heads, then you win some certain money. Which case do you want to play? When the money of the winning is 500 or 1,000 or 2,000, why you don't want to play this game? When you are playing this coin toss, right? Then you have the penalty. If you get to the tails, then minus 1,000. That is huge, right? Chat. Okay, number three. Okay, 2,000. Of course, number 2,000. But you also have the chance to lose 1,000. So 50-50, right? But of course, like if we calculate this one by the expected value, we know the what we have to do. So here, 500 times 50%, because like this twin cost is a 50% case, minus 1,000 times 50%. So like if we choose number one, then the expected value is minus 250. Then if I choose like a second one, 1,000, then this is 0 expected value. And then third one, 2,000, some people choose this. 500, right? This is better, of course, because the expectation wise, expected value wise, that is 500. So everybody have to choose 2,000. But however, some people don't like to take this one. That is because they may lose 1,000. Because 50-50, you may lose 1,000. Even though your expected value is 500. So that human don't like to lose the twice more than the benefit. Meaning is we actually afraid of losing money rather than gaining money. I think you may have the experience. Maybe like when you put the money into the stock market, then you put the money into the stock market, right? Then the money probably some people so some people don't like to put the money. It's because like, they are way more afraid of this losing money. So this one is a loss. That is called like a loss aversion. That is a tendency of to prefer avoiding loss to acquire equivalent gains. The principle is prominent in the domain of the economics. What distinguishes loss aversion from the risk aversion is that utility of the monetary payoff depends on what was previously experienced or was experienced to happen. Some studies have suggested that loss twice as powerful psychologically as gain. Loss aversion was first identified. But we probably very scared to lose the money rather than gaining money. For me, for example, if I put the money into the stock market, the cutting loss is more pain compared to gaining twice gain. So this is the human psychology, actually. We probably afraid of loss. So if we play this kind of game, right, then many people may not like to take it because they may lose 1,000. Even though they have the chance to gain the 2,000, some people don't like to take it, don't like to play it. Okay, so that is one case. Second case. If the game two, right? So the coin toss game are only one, same things, same rule, but you already paid the 500. as a partner fee. So then you want to play or not, right? So this case, you already pay. Like last time is you didn't pay. You may lose like 1,000. You may gain the 2,000. Okay. So this time, okay, maybe like people choose like number 3. But you also have the choice to you don't want to play. But you already pay 500. Then what's gonna happen in our mind? What's gonna happen psychologically is they like to play more because they already paid this 500. So they feel, oh, I'm wasting my 500 if I didn't join to play this game. So that is the mind theory. Then this kind of the mind is called like a sunk cost. Humans don't want to waste what they invested before. In economics and business decision making, sunk cost is a cost that has already been incurred and then cannot be recovered. Sunk cost contrasted with prospective cost, which are future costs that may be avoided if action is taken. In other words, the sunk cost is the sum paid in the past. That is no longer relevant to the decision about the future. Even though the economists argue that sunk costs are no longer relevant to the future regional decision making, in everyday life, people often take a previous expenditure in the situation, such as repairing a car, house, into their future decision regarding those properties. So this is another case, what we face in the trading. For example, you may lose the money if you put the money into the stock market, right? Then what's gonna happen is, okay, for example, I put the money in the, for example, Apple. Recently, Apple is going down. So for example, I cut my loss. Now I lost my 2,000. The next time I trying to win. I trying to gain my the money again. But then I will consider about my past transaction because I lost 2,000 previously. So I trying to recover my 2,000 on top of current transaction. In the current transaction, I trying to recover previous transaction. That's the sunk cost. So the sunk cost is very, in a way, dangerous because we have to consider separately. This time and the last time the transaction are different. So here we have to be careful about this. But this is a human's behavior. Human always think this sunk cost. Even though the sunk cost itself, we have to think separately. Number 3, okay. Okay, so you have the 3 options. When you're trying to purchase a laptop, for example, fully customized laptop 3,000, well customized laptop 2,000, no customized laptop 1,000. Okay. Second one is guitar. You have the 3 options. Legend level 5,000, professional level 3,500, normal one 2,000. Okay. Now, which one you want to choose? Like number 1 or number 2 or number 3? I think many of the people, for example, another example I give you, it's maybe like lunch, right? Lunch, we have like 3 type of the set, lunch set. Special lunch set or some special gorgeous lunch set and then special set and then normal set. If that is like $15, $10, $5, which one choose? Which one do you want to choose? I think, okay, I have 2, right? Yes, I think so. Most of people, they love to choose the middle one. That is because people are, after we see the number, always after we see the number, right? We tend to choose the middle one. This is also proved by psychology that many people tend to choose the middle one. So this is one of the reasons when any store, they try to label their price tag, they are consider about the middle one. When they try to have like 3 types of the price, they know the second one, the middle one, people tend to choose. So that's why they put like a proper optimized price for the second one. First one, then third one, we just showing only. So this kind of things is called anchoring. And then humans tend to choose the middle one. The anchoring or focalism is cognitive bias, where the individual depends heavily on initial price of the information offered. Consider to be the anchor to make subsequent judgment during the decision making. Once the value of this anchor is set, all the future negotiation, argument, estimate, etc. are discussed in relation to the anchor. For example, initial price offered for the used car set either before or at the start of the negotiation. Set arbitrarily the focal point for all following discussions. Prices discussed in the negotiation that are lower than the anchor may seem reasonable, perhaps even cheaper to the buyer, even if said the prices are still relatively higher than the actual market value of the car. But so anyway, so if we see the actual number, then people that I already told. So people tend to choose the middle one. It's because it's already showing the number. And then this kind of the behavioral economics for the trading, in case of the loss aversion, I already mentioned. So that since the psychological impact of the loss is greater than that of the profit for the same amount of the money, we're trying to avoid loss more than necessity. For example, right, Zoom is going up after the COVID, but lose the chance due to the fear of the whole market loss. That time, I think the last year, 2020, March, Zoom is always going up, always, like almost every day. But most of the market is coming down, it's going down. I actually bought the Zoom because I know this one is going up anyway. But then I also told my friends maybe we better buy the Zoom, but nobody is joining that because everybody has a fear. So most of the people consider and then also the fear about loss instead of the gaining money. So this is one of the example. The loss aversion. And then the next one is the sunk cost. Even if the cost is unrecoverable, the psychology of the wastefulness can distort our judgment. For example, you lost 2,000 in the last trading, trying to recover the cost in different transactions. So that I mentioned, if I lose money in the previous transaction, I try to recover in the next transaction. But that we have to think separately. Anchoring, the judgment is proved by the standard shown first, not by the absolute value of the amount. Not looking at the fundamental number, but the current price only. If user is the investor doesn't look the fundamental, and then it's only checking about the current price, then they may go into here, go into this way. But so that when we try to judge, we have to consider about not only the shown number is correct, but also we have to see from the behind. They have many ways we can measure whether this price is correct or not. From the market wise, we can also oversee we can just more largely we can see the number. So we try maybe better avoid. For example, you have a guitar, right? So the one store they have 3 different number, right? Then again you have to check about another music instrument store to check about the different guitar, and also another store. Likewise, you can do that kind of things. Then you instead of getting the one information from the one store, you better clearly see more the market value. Okay. So then the lottery, the game 4. this is a lottery, right? So that choose one from the 100. Then if you just pick up one from the 100 piece of the sandpaper, then first prize is 300, but 10 piece, 10 quantity is there. Two prize is $30, 50 piece, 50 quantity is there. Three prize is minus $30, and then 50 piece. Four prize is minus 50, and then 10 piece. And then fifth prize is minus 1,000, and then two pieces. You want to play this one or not? That is a question. You have like 100 piece of the paper there inside the box, for example. You're trying to pull one paper out of that box. You may see either from 1 to 5, either one of them you can choose. You may lose the 1,000, you may lose the $30, you may gain the 300. If you have this game in front of you, you wanna play this or not? And some people no. Okay. Okay. Yeah. Okay. Because you afraid of this minus 1,000, right? Or maybe like a minus a lot. But yeah, it has a lot of this minus 1,000 is huge. Expected value, if we calculate from the another comment. No. Okay. Thank you. So expected value wise, first one 3,000, second one 1,500, third one minus 1,500, fourth one minus 500, fifth one minus 2,000. If we sum up all this number, 500 is expected value. Meaning is, if you pick up 100 times, not one time, then you definitely win 500. But most of people, because this is a one-time chance, and most of people are afraid of this minus 1,000. Because you still like 1 out of 50, you may choose this, and then so that's why people don't choose. Why? Because like psychologically, this one is called like subjective probability. Humans tend to have the bias on probability. If we calculate, like calculation is here, right? Calculation wise, its expected value is it's positive. But however, humans don't see the calculation number. We see based on our decision. We judge the probability based on our like instinction. Like subjective probability is a type of the probability derived from individual's personal judgment or own experience about whether specific outcome is likely to occur. It contains no formal calculation and only reflects the subject's opinion and in past experience. For example, right? You take the air flight. When you take an air flight, for example, from Singapore to San Francisco, that is 17, 18 hours. Okay? When you take that air flight, right? You may feel scared. Why? It's because there are very slight chance it may crash. But the crash is, of course, like it's a significant issue, right? Significant. It's very crucial things. Many people afraid of the very tiny probability. Even though that won't happen often, and then the probability is very, very less. But still, because of that incident, like the warriors give us a lot of concern. So that is one of the reasons why like many people is afraid of like a flight, because the 1%, like 0.001%, we may choose this 5 price. You may see that. So we trying to change, not from the actual calculation. We have own the subjective probability. Okay. Second one. Okay. Let's go to this. When someone says, "I give you 1,000 now," or "I give you 1,100 a year later," which one do you choose? I think most of the people, I don't know, which one do you want to choose? Like when somebody say, "Okay, I give you the 1,000 now," I give you the 1,100 1 year later. Which one do you choose? Okay, this one is an easy question. 1, 2, 2. Okay, some people choose 2, some people choose 1. Okay, most people, okay, they choose 1. This one is also according to some of the psychological study, and also they have some of the experiment. Many people choose the first one. Why? Because human like instant result right now. This one is called like present bias. Human tend to choose right now. Present bias is a tendency to rather settle for the small present reward than to wait for the larger future reward in trade-off situation. It describes the trend of the overvaluing immediate reward while putting less worth in long-term consequences. The present bias can be used as a measure for the self-control, which is a trait related to the prediction of the secure life outcomes. Even though this number, right, 10% interest rate, but still people tend to choose the number 1. And then there's another experiment. For example, we have like 20 kids in the room, and then we say, "Okay, I give you the marshmallow. I have the marshmallow right here. If you choose now, then I give you 1. But if you can just wait 20 minutes, then I give you 3. Then after this experiment, they choose, most of the kids, they choose now. So this is a present bias. It's easy to understand, okay? So that when coin toss result is like the below, for example, heads, tail, heads, right? Which one do you choose next? Heads or tail? So this is another very simple question. So I think heads, okay? Yeah, heads, because like there's a consecutive heads here. So yeah, people tend to choose a head. This one is called like gambler's fallacy. Then human tend to choose okay. So this one is a previous one. Sorry about that. So the gambler's fallacy, as known as a Monte Carlo fallacy, occurs when the individual erroneously believes that a certain random event is less likely or more likely to happen based on the outcome of the previous event or series of the events. So what happens is people, after people see this consecutive heads, then they may think, okay, again the heads may come. It's because like from the past the result, past outcome. But this number 11 is still again the 50-50 because the heads and the tail is anyway 50-50, right? So people don't consider about, people tend to choose based on the past outcome rather than choosing the 50-50 case. So this is kind of like gamblers. It's another bias which we have. The case is, yeah, but anyway, so the one is, so this one, the subjective probability, is a discrepancy between actual probability and human intuition. So the Tesla price goes up, but avoid to join the price due to the past image of the Tesla. Now he loses the opportunity of the earning. Maybe this one is like last year, maybe even now, maybe the Tesla is keep going up. Then people are afraid to join this. They have it's basically is like yeah. So this one is also another subjective probability. Also like from the maybe like this one is also related to this too, like gambler's fallacy. Okay, so the second one is present bias. Even in the case where it's better to procrastinate, the priority is to get the profit as soon as possible. So that even though the price still goes up, people are satisfied with the current profit before it goes very high. Yeah, okay, so this is a present bias. Another case here. So, for example, right, so the price goes up and it keeps going up. We probably satisfied with current price because you gain already. But after that, the price is still keep going up, and then you probably lose that opportunity. That kind of things, like you want to have now, you want to have that amount of the money now, rather than just waiting. But of course, like most of people are not so good at the waiting. That's why, for example, Warren Buffett, right? Or his case, he gained a lot of money. He waited for a long time because he has patience. Most of people don't have that patience. He mentioned most of people want to be rich as soon as possible, but that is wrong according to him. He can wait, so that's why he become very rich. Yeah. So this is another one, the gambler's fallacy. You think the past pattern will affect the next one. In reality, each time we just get the independent result according to the probability. 5 consecutive days, the price goes up, but avoid to join the bandwagon in spite of the probability is 50%. In spite of the probability is 50%. So this is another case. So we tend to care about the past image, past things. Another example, for example, right? Maybe like some people heard about some country is rip off the money from when the developed country people is going to the developing country. We have that kind of image. So if we go there, then we worry or we concern about that. Although the percentage is not that high, for example, if some country, but still people worry that one too much. So because of the previous experience or past image, people have some kind of bias. That is coming here too. Okay, so the one of the one of the things we can overcome this kind of like psychology is maybe like you better read a book. This is one. Maybe I can just recommend one of the book from here. This is actually Warren Buffett, right? So he when he had a speech every year, I think every quarter or so, every year he has a speech and they also send the message to all the investor. When he invited the investor in his speech, he just distributed this book to everybody. Actually this one is very interesting. I'm still reading this one now. It's very interesting because like it's also talking about the psychological area, how we can overcome what we see now before, right? So I explained that one. Yeah, so that is one of the solution. Maybe you can just try to see. Another one is we just check about the price from the fundamental. This book also mentioned about the technical and the fundamental, but he also mentioned fundamental is better, of course. Then fundamental, I always bring the fundamental number in my session. So if you want to, today I won't do that, but maybe like some other time I will do. So, but if you want to do by yourself, we can just read this book too. I already explained how we can describe the fundamental data in the Python. So, and also another way, what we can do, like how we can measure the psychological sentiment in the market. We can utilize the Twitter and the news. How I can show you about these things. One is I grab this one is in stock news sentiment, right? So for example, right? So what we can do, by the way, where I got this one is Finbiz. So if I put, for example, Amazon here, see the Amazon news here, right? So I'm collecting this news and then put this somebody. Sorry, can you mute? So okay. All right. So here I put the ticker Amazon, Tesla, Google, and then I'm getting the news here headline, and based on the headline, I put this the sentiment library they have. I'm using this sentiment interest analyzer, and based on that, I get the number here. So that some day I see the positive, some day I see the negative here. That is one of the way we can utilize by Python this news. Okay, so the news case. Another one is Twitter. Twitter is like this. I have like Twitter. I have a Twitter account. I gain the Twitters, each one with the Twitters, and also the Twitter has stock market information based on the dollar sign, Tesla, something. Then we can grab some people's tweet for some particular stock. Then we see about which one is positive, which one is negative. Also using the same scoring measurement by which one here around here, yeah, sentiment intensity analyzer. Okay, so this is another way we can do. I haven't do the back test for this, but because recently I started doing this, so maybe I will let you know the result, like how it works. And then if this one is reliable, I can bring back the information in the another session. Okay, so that's it, I think, for today. Any question? Okay, so that's it for today. Oh, by the way, so I have the YouTube video, and then it's archiving all the session here. So you can just go check if you want. Otherwise, I think now is 7:24. Okay, so it's almost 1 hour. All right, so 2 days later, I will talk about the Tesla, and then not only the Tesla car. I will talk about the Tesla infrastructure, not only the car itself. We'll talk about the infrastructure, battery, their strategy, all of this, factory, and then why the Tesla is keep going up, and then why like ARK, they are investing a lot of money. They are expecting like 3,000 in the 2025, and then that is very interesting. So if you want to hear, then you can come back in 2 days. Okay. All right. So that's it. Thank you so much. Bye.